Are you getting pressure from finance to justify or reduce your cloud bill? CloudZero is the only cloud cost platform loved by engineers and trusted by finance. CloudZero can identify unused, idle, or over-provisioned resources, alert you to spend anomalies, and organize 100% of your spend into a framework that mirrors your business structure, like cost per customer, product feature, or team. It's the most powerful platform ever built to provide accurate, granular visibility into your total cloud spend without the typical pitfalls of legacy cloud cost management tools like endless tagging or clunky Kubernetes support. Manage cost, optimize development, and maximize profit, all in one platform. Join companies like Rapid7, Drift, and SeatGeek by visiting cloudzero.com/cloudcast to get started. That's cloudzero.com/cloudcast. Visit today to experience immediate and ongoing savings on your cloud bill.
Cloudcast Media presents from the massive studios in Raleigh, North Carolina. This is the Cloudcast with Aaron Delp and Brian Gracely, bringing you the best of cloud computing from around the world.
Good morning, good evening, wherever you are, and welcome back to the Cloudcast. We're coming to you live from our massive Cloudcast studios here in Raleigh, North Carolina. And it is Aaron for Cloud News this week, but we only have one or two articles this week, and we actually have both a much requested as well as a longer interview coming up after the break. So we're going to jump right into Cloud News of the Week. First up, we have a continuation of the story of Docker and retiring the free tier. So as mentioned previously, Cloud News of the Week, Docker kind of said, hey, we're going to get rid of the free plan for teams specifically. And Brian talked about it on Sunday Perspective as well. And then they also came back and said, well, you know what? Based off of feedback, we're not going to get rid of this. So if you are on the free team plan, you no longer have to worry about migrating off. As Brian discussed in Sunday Perspective, you know, some of these things, honestly, from a business perspective, it might make sense. From a community perspective, it might not. And so we'll see if this is just a temporary rollback or if this is a permanent rollback. We will certainly keep an eye on that. Next up, we have MariaDB. MariaDB adds auto-scaling and serverless analytics to its cloud database as a service. So they have SkySQL. SkySQL is their cloud database as a service, and it has been growing in features and popularity as well. And they want it to continue to iterate on that. And so the auto-scaling, that is an obvious benefit of something like this to bring into the product. But then also a lot of folks are really trying to figure out, get costs under control. And so the serverless analytics portion was specifically integrated to help with cost and cost overtures and cost consciousness going forward. With that, I'm going to wrap up Cloud News this week. Like I said, very short week for Cloud News this week, but we have a fantastic interview and one of our longer interviews as well. Coming up right after the break, we have Jamin Ball, partner at Altimeter Capital, but also author of the Clouded Judgment Substack. And he's going to be talking about SaaS business models and financials.
Datadog is a SaaS, cloud monitoring, and security platform that enables full-stack observability for modern infrastructure and applications at any scale, providing teams dashboarding, alerting, application performance monitoring, infrastructure monitoring, UX monitoring, security monitoring, and log management in one tightly integrated platform, plus 450 plus out-of-the-box integrations with technologies including cloud providers, databases, and web servers. Aggregate all your data into one platform for seamless correlation, enabling teams to troubleshoot and collaborate together in one place, preventing downtime and enhancing performance and reliability. Get started with a free 14-day trial by visiting datadog.com/cloudcast. That's datadog.com/cloudcast.
And we're back, and we actually have a guest that has been highly requested, whether he knows it or not. And we're going to get to that in a second, but we also have a promotion to announce this week as well. Brandon Whichard, Software Defined Talk podcast. And Brandon, you've been a guest a couple of times, but we're elevating your status this week. You are now officially guest co-host. So,
well, first of all, I'm honored. I will do my best to sit in for Brian Gracely and fill his big shoes this week.
So congratulations. That's an honor we don't bestow on many people. But to get to our guest, we have Jamin Ball, partner at Altimeter Capital. And we're going to talk today all about SaaS and a little bit about economic models and financials. So, Jamin, why don't you give everyone a quick introduction?
Yeah, well, first, thanks for having me. Always excited to talk all things SaaS. It's a topic near and dear to my heart. If SaaS can be a topic that's near and dear to folks' heart, but so I'm currently at Altimeter Capital. We are both a public fund and venture fund. I'm work on our private fund, so partnering with companies at the early growth stage. Usually think of that as kind of Series B, plus or minus, in and around infrastructure software is usually my sweet spot. Been here a little over 2 years. Before that was at Redpoint Ventures for about 5 years. And prior to that was at Morgan Stanley on their investment banking tech team out in Menlo Park. I joke that I've pretty much been in a 15, 20-mile radius my entire life. So I grew up in the Bay Area, went to Stanford, and then I've worked on the same street ever since graduating. So that's my quick background. I find what I like, I find what I'm comfortable with, and then I stick to it.
And we could say a rare, legitimate, longtime Golden State Warriors fan, right?
Exactly.
Like you were there during the lean years, so you get to legitimately enjoy the good years.
Exactly. Yes. While we still have them, let's keep our fingers crossed for a few more.
It doesn't last forever. Steph won't be there forever, but for now,
exactly. Enjoy it while we can.
Yeah, no, it's fantastic. Yeah, and I'll add to that too. Yeah, like it's so rare to run into a true native, without a doubt. And so, first of all, congrats. That alone should be, a milestone and/or an award for you.
There we go.
So let's talk about the Clouded Judgment Substack.
Yeah,
you started it back in 2020.
Yep.
And we came across it, about 2 years ago now. And we regularly reference it during our weekly cloud news. And we've recommended it numerous times as we think required reading for anyone out there that's interested in the business side of SaaS. And so tell everyone a little bit, like, what motivated you to really start the Substack?
Yeah. I would say it really goes back to the roots of what I do and the companies that I work with, right? Generally, when we're partnering with entrepreneurs, with founders, with startups, it's at their what I would call early growth phase, and they're not thinking about public markets. They're not thinking about going public yet, right? They're years away from that. But I'd say what we often found was there was kind of this hard stop inflection point where companies went from not caring or thinking about the public markets at all to all of a sudden saying, hey, I need to pay attention to it. I'm going to go public in 18 months. And then it was kind of this, not a sprint, but a really quick process on getting up to speed around what do public markets care about? What do public market investors care about? How should I think about positioning the business? And how should I think about the public markets? And the challenge there was just a lack of a lot of historical context that was missing, where it was tough to really know what is normal over a long arc of time versus what is normal in that moment when folks started to care about public markets and public market metrics. So the idea was, what is a set of content that can in many ways drip feed entrepreneurs and founders with the quick 101 on what's going on in the public markets, what's happening with multiples, what are kind of average or median stats of what it takes to be public, and how can folks start paying attention to that much earlier so that it's less of this kind of hard stop, hard pivot in terms of thinking about public markets when they need to, and more about how do we build the foundation of a public company in the early days that we can then kind of grow with and grow into. So that was kind of the impetus. Back when I was at Morgan Stanley, and when you're a first year analyst, kind of right out of college, like everyone has the kind of, I don't know, even remember what we called them, but like the low level tasks, right? Kind of the stuff you give the new people, the young people, And what I was the comps guy, and so every week I'd refresh the comps, the software comps, the internet comps. We'd send them out to both internal lists as well as external lists. And I just remember thinking, wow, even these really senior folks, they have the printout, they print it out, they leave it next to their desk, they reference it every day. Like, people find value in it because a lot of these metrics, whether it's consensus estimates or just historical performance, it's all out there. It's all public information. But the aggregation of it didn't really exist. And so I said, man, there's people got a lot of value out of this. I complained about, doing the low level tasks right out of college, but people got a lot of value out of it. Like, I should recreate a version of that. And so that was the high level story of how it happened and how it came about. And then it's taken on a little bit of a mind of its own. And now it's in many ways just a personal journal where I'll write down a bunch of thoughts that I've had over the week, whether it's on macro, whether it's on software, whatever it might be. But because there's a lot of people who read it, I kind of have to crystallize my own thoughts a little bit. And so in many ways, it's selfishly something that helps me just decompress everything I was thinking about through the week into a hopefully somewhat digestible and coherent narrative.
Yeah, no, I think it's excellent. So maybe going back a little bit, because probably not everyone's familiar. So comps, I think you mean comparables, right?
Yes,
Give everybody a quick, what is it as an investment analyst when you putting together comparables? Like, kind of give us the 101 what that means, because I think that's a big, really what your newsletter is showing. So go ahead.
Yeah. Well, to make it tangible, think about a comps sheet or comps table as basically the big massive graphic at the bottom of the newsletter, where every row is a company name and every column is some metric, whether that's a valuation metric, like a revenue multiple, or an operating metric like revenue growth or gross margin or free cash flow margin, or kind of share price performance, whatever it might be. You have every row is a company, every column is some metric. And when you aggregate them together, you can just do kind of quick analysis of, hey, let me sort by, descending revenue multiple or descending revenue growth or descending free cash flow margin. It kind of just gives you a good picture of, okay, amongst a universe of companies, and for myself, I've chosen cloud software. What does good, better, best look like in terms of, whatever metric you want to analyze? And so comps, that's really what the comp sheet is.
Very nice. And so let's maybe even step back and kind of give everyone a 101 in terminology. In the SaaS world, what do you think are some of the most important terms and why? And of course, everything has a 3-letter acronym. It seems like, whether you're in the tech industry or not. And so take everyone a little bit through the metrics as well as the acronyms.
Yeah, I would say I'll maybe leave out the basics, because I assume there's just a base level. So I'll leave off kind of like revenue and stuff like that. But in the SaaS world, right, maybe starting at the top, you have ARR, annual recurring revenue is a big one. Customers will sign a contract that says, hey, over maybe a 2-year period, I'll pay $200K, right? And so what does that mean? That means in a 1-year period, you're paying $100K. And so ARR just is the aggregate of all of your, kind of like 1-year deals. And so in many ways, you can think about ARR as the revenue you'll generate over the next 12 months, assuming you sign no customers, there's no churn, or any other changes. So ARR is usually the top level metric. Related to that is net new ARR. So net new ARR is just what is the incremental ARR you added in a quarter. So that takes your new logo ARR, so new customers you've signed. It factors in expansion. So customers who, maybe that 100K deal turned into 150, and so you got 50K of expansion. It takes into account churn. It takes into account contraction. So net new ARR is basically the aggregate. Your ARR changes from one quarter to the next. And that's usually a metric I'll look at to see, especially in kind of companies at that Series B, Series C stage, right? Is there a healthy trend of net new ARR increasing quarter to quarter? I'd say maybe some of my favorite metrics, like I'll remove just kind of like gross margin, operating margin, some of the more basics. But I'd say 2 of my favorite are net revenue retention and the payback period. And so what are those? So net revenue retention says, how much are your existing customers spend changing from year to year? And it's a really good indication of the health of a product, customers' love for a product, and ultimately the health of the business. And so what is net revenue retention? That says, take the cohort of customers from a year ago. So let's say you had 10 customers who were in aggregate paying you $1 million or generating $1 million in ARR. And what is the ARR of those 10 customers today? And so what that, maybe the 10 customers turned into 9, right? And so now you have 9 customers paying you a certain amount. But let's say those 9 customers all started paying you more, right? And so now you have 9 customers paying you 1.1 million, right? So what the net revenue retention does is it say compare that 1.1 to the original 1, and what is that percentage? That would be 110% net revenue retention. And the important thing to call out here with that metric is it's inclusive of customers who left, it's inclusive of churn and contraction, and inclusive of expansion. The metric's a little tricky because I'd say that's just kind of in a vacuum how it's calculated. But now in software, we have consumption models, which are a little bit different. We have kind of mixtures of consumption and true SaaS models. And so everyone kind of actually calculates this metric a little bit different. And there's no gap definition of net retention. And so it is really important to read the footnotes to get the actual picture of how each company calculates that metric, because it does differ from company to company, especially if companies aren't including kind of churn or contraction. So reading the footnotes on that metric is important. And then maybe the final metric I'll talk about, which is one of my favorites, is the CAC payback, right? And so in software, we generally have this view that they will go, the businesses transition from kind of growth stages where they're unprofitable to steady, now, not growth, whatever you want to call that, kind of steady growth and profitability, right? So kind of high growth and no profits transitions to low growth and profits once businesses hit kind of that stage of their S-curve. I'd say there's a lot of faith investors take in that premise. And I think one thing you have to believe is that you have an efficient go-to-market engine so that you are, what it takes to acquire a business is ultimately worth it, given what that business and customer will pay you, over the arc of its life. And so what is the gross margin adjusted payback? It's a little bit of a mouthful, but how is it calculated? How I calculate is I say, I'll take the previous quarter's kind of fully loaded sales and marketing expense. I'll divide that by the net new ARR added in a quarter, right? So that's the incremental ARR we've added, which I kind of described earlier. Multiply that by the gross margin, and then multiply that by 12. Okay, so what does that basically mean? Not in math terms. It says I spent X in a quarter, and that got me Y, right? And I'll look at the kind of gross margin adjusted net new ARR added because it just normalizes for businesses, right? And so if I spent $1 million in a quarter in sales and marketing expense, and that generated me $500K of, right, call that net new R times gross margin. What that means is it's going to take me 2 years to pay back that $1 million, because in the first year, I'm going to generate $500K of kind of net new gross profit. And then in the year after that, I'll generate $500K. And that aggregate will have paid back the $1 million in sales and marketing cost. And then everything after that is kind of incremental margin that flows to the bottom line that has already paid back the initial cost to acquire a customer. So in that example I just gave, that's a 2-year payback. What I generally look for and how I think about that metric is if you are paying back your customer acquisition cost within a year, that's best in class. That's really good. If you're in a high growth mode, you're probably ramping a lot of sales reps, right? Your sales team's not as efficient. And so you won't have as efficient of a go-to-market engine. Maybe it's in that kind of 12 to 24 months. And then, kind of 24 plus is when it starts to get into a little bit more like, not danger zone, but like, I want to believe there's a path for it to get better than that. Or I want to believe the trend line is down. Maybe you're at 27, 28 months, but, before that you were at 30, before that you were 32. And I'm kind of seeing that trend. And then above 3 years is when it starts to get to the danger zone. But again, like I call that out because I think that metric is a good leading indicator for when businesses can become profitable. Because if you're not acquiring customers efficiently, I think there is a big question of, can you ever become profitable, or does the growth have to go to, basically nothing for the business to become profitable? And again, it's a little bit like when I do it for public companies, it's a little bit of a swag. Like, again, if companies were to disclose true ARR, I think some companies do. We could look at this metric more accurately, but on a quarter to quarter basis, sometimes you get some seasonality mixed in, or if you kind of have to use revenue times 4 as a proxy for ARR, right? Sometimes Q4s look great because you get a lot of bookings in Q4, and then Q1 doesn't look as good, just based on some seasonality. And so the net new Q4 to Q1 kind of obfuscates the market. So kind of quarter to quarter, there is noise in that metric. But on the aggregate, I think it's just important to look at trends and kind of how ultimately business are faring in their sales efficiency, because that is kind of an engine where I think SaaS companies can get a lot of leverage from if the potential's there. So I'll stop rambling. Hopefully that makes some sense.
It's an excellent overview. I know it's pretty detailed there, all those metrics. So I think that's sort of like, the important things to kind of look at, like how a company is performing. But then I think the real purpose of the newsletter, right, is then comparing them. And I think what I find in the newsletter that you're doing is using multiples to do that. So maybe talk about one, just to find like what a multiple is, and then like why is that a good reason to compare things? And I'll preemptively ask you right now, and it's like, what are maybe the problems with using multiples as a comparison?
Totally.
So go ahead.
Totally. So I would say, what is a multiple? A multiple is a valuation framework, right? Ultimately, what investors want to know is, what is this business worth, and how can I get to that ultimate answer? In a perfect case, in a perfect world, right, the right answer to that question is, well, a business today is worth the discounted value of its future cash flows. I mean, that is ground truth, right? The cash flows a business will generate into the future, if I discount those back to present value, that is what I'm currently worth, right? That's what you would hear as a DCF, a discounted cash flow analysis. The trouble with those is that, especially for software companies, they're very, like, most of the value sitting in a DCF sits in the outer years, right? If you have negative free cash flow in year 1, 2, 3, you have a little bit of free cash flow in year 4, more in 5, 6, 7, right? There's just a lot of out year assumptions baked into a DCF. Well, what is the growth rate 7 years out? What's the free cash flow margin 7 years out or 10 years out? There's a lot of assumptions built in, it's kind of hard to know, like, okay, is that accurate? Is it not accurate, right? So a DCF is one valuation framework. Another is a multiple, right? And so let's say, what multiples can we look at, right? You can look at a revenue multiple, a gross profit multiple, an earnings multiple, an EBITDA multiple. And I'd say the nice thing about SaaS is usually, right, for the most part, the business models are all somewhat similar. And so in theory, there should be a metric that we can look at that will kind of like evenly, I guess you can't see me, but I'm doing air quotes, right? Like evenly assess value to all those businesses at once. So what should that multiple be? What should that metric be, right? I'd say obviously the true metric is more of a free cash flow multiple, right? So taking what is the future free cash flow of this business, and usually I'll look at an NTM, so next 12 months. So 1 year forward, what is the free cash flow this business will generate in the next year? What is a multiple I can apply to that to give me a value for the business, right? That's maybe second ground truth, right, to a DCF, still based on free cash flow. Free cash flow is always kind of the iron law. The challenge is not every software company generates free cash flow. And so how do you value a business with negative free cash flow today, who again, right, if the business follows the classic arc of a software company of high growth, unprofitable, low growth, profitable, it can have negative free cash flow today, but still have value based on the free cash flow it will generate in the future. So if you just used a free cash flow metric or multiple on a business that was going to generate negative free cash flow over the next year, you'd get a negative value, right? And I'm sure there are some pundits out there who would say some of these businesses are zeros. They'll never generate free cash flow. But it's harder to take a broad set of businesses and evaluate them all on a free cash flow metric when a lot of the multiples will just be NM, right? It's not meaningful. It's like you're not going to ascribe a negative enterprise value to a business. So what does that lead you to? Okay, what is the metric that everyone has that you can do some sort of broad-based comparison? Okay, well, they all have revenue, right? And, this isn't kind of the 2000, 2001 internet bubble where you had a lot of companies where the multiples were something like eyeballs to your website or website visitors or something else, right? This is true revenue. That is the metric where we can line all the business up and say, okay, what is the value of the company divided by the revenue you're going to generate over the next year? And what's that multiple? Everyone will have revenue. Not all revenue is created equally, right? We do have a dispersion in gross margin profile. But what I'll say is, in a perfect world, a revenue multiple is not just correlated to revenue growth. You can have two businesses growing 100%, but one business has an 80% gross margin and 20% free cash flow. The other business is growing 100%, has 70% gross margin and negative 20% free cash flow, right? So two very different profiles. Why a revenue multiple is imperfect is because, in theory, a revenue multiple should factor in or discount these other factors, right? And so if the business growing 100% with 20% free cash flow margins is trading at, call it 12x, the business with 100%, the same growth, 100% growth, but negative 20% free cash flow should be trading at a discount to that, right? Because there's some haircut to the other metrics or qualities of the business. And so in a perfect world, a revenue multiple can factor in these other aspects of the business. And that could also be things like annual dilution, right? A company that is adding 5%, dilute, and by dilution, I mean, if you have, 100 shares in the business this year, in a year, you're going to have 105. And so the share count's going up. So existing owners are getting diluted, right? A business that is diluting the existing shareholders 5% a year should be dinged more than a company diluting shareholders 1% a year. And so again, in a perfect world, I think a revenue multiple factors in things like margin profile or kind of competitive positioning or annual dilution. The tricky thing is in certain moments in time, a revenue multiple tends to correlate very highly with just revenue growth, and you forget all the other stuff, right? Call that 2021. And then you have times when a revenue multiple will discount in these other business properties. But again, like nothing's perfect. And so a revenue multiple is a crude estimation. But I'd say the benefit of a revenue multiple is you can kind of line everyone up and kind of compare everyone on a relative basis, where it's harder to do that with the free cash flow multiple for companies who don't have free cash flow multiples. And DCFs have just as much assumptions built into them as a revenue multiple would anyways. And so it's like, why go through the brain damage when you can kind of just swag it? So I'd say a revenue multiple is a swag valuation metric, which at certain points in time, when it's highly correlated to only revenue growth, it's dangerous. And in certain points in time, when in theory, it factors in both quantitative and qualitative things, right? Qualitative being, competitive positioning or market TAM, right? Again, it's all imperfect. A business should always be worth the future value or the present value of its future free cash flows, but it doesn't always work like that. So I'll pause there.
No, I was just going to say, so it seems to me like a revenue multiple. It's a model, but then it also has a bit of a lens applied to it, and that lens is almost like time based in a certain way. Like you mentioned, like, hey, 2021, you're going to apply this kind of filter, or other times you're going to apply certain other kinds of filters, and you might come with different companies. The perception of value might be different at different times based off of the revenue multiple perception or lens used at any given time. And so that, I think that's a perfect segue into probably the next one, which, this being, we tend to do our shows to be a little less timely, but I have to bring this in of like the rise of interest rates.
Yeah.
And so that seems to me like a perfect time to kind of bring in that of like, okay, what does the rise of interest rates do? Like, how does this affect multiples? How does this affect valuations and perceptions? Talk about that for a little bit, if you don't mind.
Yeah. I'd love to. And maybe just to put a bow on the last point, the revenue multiple, if we looked at the correlation of revenue multiple to growth in 2021 across a basket of 90 software companies, that correlation was close to around 0.9. So the R squared in a scatter plot, right, around 0.9. Today, it's like 0.4, 0.5, right? And so the correlation has dropped dramatically from just looking at rev growth to there's other stuff now factored in, right? But to your point on rates and valuation, so as you can probably see in the charts that I'll publish, right, kind of the main chart that I publish will show the median revenue multiple and then the 10-year interest rate. And you can kind of see is as rates go up, multiples go down. So why does that happen? Well, there's probably two answers, right? If you were thinking back to the DCF analysis, right? The pure math will say, okay, if a business is worth the present value of its future cash flows, as interest rates go up, the discount rate goes up. So all that is saying is I'm going to discount more future free cash flows, which means the present value is less. So if the present value is less, the multiple goes down, right? So that's kind of the straight math answer. I'd say in practice, what actually ends up happening is, and let me use an example, right? So let's say, you as an individual or you as a big asset manager, right? You have a target return that you want to generate every year on your investments, right? And again, let's use a big asset manager that is investing in, cloud software stocks or equity, as well as debt and credit and real estate and currency, whatever it is. You have this portfolio of assets that you're investing in, and you want to get a return every year. And you get to allocate your dollars to each one of those asset classes in a way that you think will generate you that return. When interest rates are zero, what does that tell you? It says, well, I'm not going to buy a lot of bonds. I'm not going to buy a lot of risk-free assets. I'm going to allocate very little to that portfolio, because why would I allocate something to a portfolio that's going to get me 1%? It's risk-free, but it's only 1%. So instead, you end up allocating more to riskier asset classes or higher duration just meaning kind of more of the value is based in the future, assets like cloud software stocks, where you say, hey, this is more boom or bust. I'm going to allocate nothing to that risk-free bucket that's going to generate me 1%. I'm going to allocate a lot more to this stock portfolio that could generate me 50%, or it could lose me money. But either way, it doesn't make much sense to put money in that 1% basket, okay? Now what happens is rates rise. Now all of a sudden, I can get 4 or 5% risk-free from the government, right? I can invest in these bonds and stocks. So what am I going to say? I'm going to take money out of my equity portfolio, and I'm going to put it into this risk-free basket that is now going to give me 5% a year for free, guaranteed. And what happens is you take all that money out of equities, right? You sell them and reallocate. That all happens at once from these really large, think hundreds of billions of assets under management, leaving the equity market, going into kind of bond credit markets, because that asset class is now a lot more attractive than it was when it was offering 1%, not 5%. And so what ends up happening in practice is as rates rise, you have these flows of capitals that move out of risky assets and into risk-free assets. And when that happens, you get kind of this dampening effect of valuations, right? And so that's what we saw over 2022, which is a lot of capital flows just left equity markets, and in particular left the riskier asset classes, which is cloud software stocks. And I say riskier because most of their present value is based on many years out, right? Free cash flow. So cloud software and riskier growth assets were kind of hurt the most and hurt first as you had these capital flows that shifted. So capital flows are really a huge reason for why multiples fall when interest rates rise.
Yeah, so I think that all makes sense, and I think that's sort of what I think all of us in the industry are facing, right? Is sort of as that capital, as you kind of described, those flows changing. That means growth changes. Companies tend to lay off, companies reduce costs, and I think that's why it all works together, if you will. So interest rates go up, and all this other stuff happens. So, throughout this interview, I think we've gotten a good basics of hey, this is how you think of it from a financial standpoint. But of course, you're an investor, and so you're kind of faced with how are you going to allocate your capital. So I assume many of the founders come in and maybe they just have a new product, maybe they just have a vision, maybe I'll speak for all of the founders, maybe their metrics aren't good, they can't give them to you, and they're not gonna look great, but they've got a vision, right? They've got the future is going to be this. And they're probably passionate about that vision. So how do you, as someone that's obviously rooted in the hardcore metrics, balance that knowledge versus I'm evaluating this group of investors who look really passionate, and like,
Yeah.
should I give them some money, and will they eventually deliver the metrics going forward? How do you think about that?
It's a great question. I have to say, I don't think I've ever been more excited to be an investor. And that's not because like, oh, I think valuations are going to correct and all this. It's because I don't think there's been a more exciting time to be investing, right? On one hand, we have this massive super cycle emerging, which is artificial intelligence and intelligent applications, which is just super exciting to dig into. And then at the same time, I think what this year is really going to separate is the folks and companies who could succeed when capital was cheap versus the companies who have built like really good fundamental businesses. And what it also does is I think you had a lot of folks over the last few years who would say, hey, a company's metrics are XYZ, and almost made it more mathematical, the investment decision, right? Like, hey, let's stick the model in a spreadsheet, and does the spreadsheet tell me to invest or not invest? And it's people made it that simple when in reality it never should be, right? Investing isn't just a spreadsheet exercise. There's a lot more to it. And so I think what's going to happen now is it's back to basics. It's back to the fundamentals. It's really saying, hey, what markets can support big companies and what products have built, a leading experience in that market, right? So that's getting on the phone with customers. That's getting on the phone with users. It's a lot more of the fundamental work where you could say, hey, I'm going to use the financial performance as an input to my decision, not the only input to my decision. And so what does that mean for me? It's an exciting time because I think the best businesses are really going to separate themselves. I think what a lot of people will find is that the investing world isn't just saying, hey, you grew 3x last year and your gross margins were this and your net retention was that. Like, boom, let me invest. Because oftentimes what we're actually making a bet on, when we partner with businesses, is not really has the historical performance been great, but do we think the future performance 4 or 5 years from now will be great? And to have confidence on that, you really need to believe that the market's there, the product will be a leading player in that market, and the team is the right team to kind of go capitalize on that opportunity. And that sounds basic, that sounds fundamental, but I think again, in the same way public markets just greatly overskewed to only caring about revenue growth, right? Private markets did the same thing and kind of overskewed to just thinking about one or two metrics in isolation, when in reality, that doesn't tell you the whole picture. And so I get excited because I think it's going to be a great time to be an investor. There's tons of innovation. I mean, every day we're talking about internally about AI, how the space is changing, how the landscape's changing. What does that mean for our companies? What does that mean for companies we want to spend time with? We kind of have this seminal moment of a new technology, whether you want to call it a platform shift or just a major technology shift. It's a super exciting time because of this new technology and because it's, now's the time for the best businesses to really separate themselves. So hopefully that somewhat answered your question, but I'm excited and fired up for the next few years here.
Well, Jim, I'll add to that real quickly too. Like, I think something we've seen on the podcast over the years, and it's almost become a running joke now, is with valuations, not just in the SaaS space, but just in emerging technology overall. Mm-hmm. We kind of had a running joke. Everyone's a unicorn now. By valuations, right? There's so many unicorns out there, and now there's deca unicorns, and there's all these other things. Like, it just gets a little crazy at times. And if nothing else, what you're talking about, it's a sanity check.
Yeah,
it really is. It brings everyone into, all right, you need to have a good vision and you need to have good financials. Like, it's bringing discipline to the industry, which I think is like, I won't call it a correction or a large correction or an overcorrection. I just think it's, bringing things back to a more sane and sustainable level.
Totally.
So, with that, actually, I think that's a great place to kind of wrap this up. Jamin, do you have anything else you want to talk about, anywhere you're going to be, or, of course we have the Clouded Judgment Substack link in the show notes. We encourage everyone to go subscribe. Anything else you wanted to talk about, or pimp before we get out of here?
No, I don't think so. I think we covered a lot of a lot of exciting topics. There's obviously, tons more to dive into or we could have dove into. And so I'm always happy to chat, either on Twitter or elsewhere with folks who want to dig in more. But this was fun, and I appreciate you guys for having me on.
Absolutely. And Brandon, I know you want to give out software-defined Slack and the podcast, so go ahead.
Yeah, of course. I always want to promote. Yeah. So right now, everyone should go into podcast player, search for softwaredefinedtalk.com. You should subscribe. We have basically a weekly roundtable discussion. So if you enjoyed this, you can certainly enjoy softwaredefinedtalk.com. And if you want to talk to Aaron or Brian, you can actually go join the softwaredefined.com the software defined talk Slack, and everyone's in there always talking about things like this. There's a whole finance channel. We talked a lot about Silicon Valley Bank. There was a lot of chatter about this, and so and then of course a lot of chatter about technology. So do one of those things. Love to see you in the Slack. Love to have you as a listener as well.
Fantastic. Thank you, Brandon. And on behalf of Brian, who was not able to make it this week, thank you everyone for listening, and also thank you to our guests. And we encourage everyone, if you enjoyed the show, please leave us a review if you're able to leave a review wherever you get your podcasts. And also tell a friend. It really helps us. If you have feedback, of course, how to give feedback is in the show notes as well. And so for that, I'm going to close it out for this week, and we will talk to everyone next week.
Thank you for listening to The Cloudcast. Please visit thecloudcast.net to find more shows, show notes, videos, and everything social media.